All right. Um, this is chapter 16. It's going to cover auditing operations and completing the audit. This is going to be the final chapter of the 5 that's going to be on the midterm. So we'll get through chapter 16 today, and then next week we will go over, hopefully I'll have the project picked out for this class, hopefully by next Monday. We'll hopefully go over that, and we'll do an exam review as well. So try to tailor out what questions and what material is going to be relative to kind of give y'all something to focus on in your all study. So does anyone have any questions from chapter 15 before we move to chapter 16? Everyone's okay? All right. So auditing operations. Corporate earnings are considered an extremely important indicator of health and well-being of corporations. And I think that pretty much is self-explanatory there. A corporation is only as strong as its earnings. So measurement of income is generally regarded as the single most important function of accounting. And we know that that is very important because of all the rules and regulations that U.S. GAAP puts on these corporations, and how they're able to actually measure income and when income can be recognized. So income measurement is very important. Conservatism in the measurement of income. Sorry, I didn't sleep well last night. You all bear with me. Powerful influence on revenue and expenses. It's important because of subjectivity involved with accounting estimates. Assets, accountants choose lower of 2 or more reasonable alternative values. Why do you think that? Why do you think that they would do that?
To use conservatism.
Right.
So they don't falsely inflate the earnings or something like that.
Right.
It's always better to record the lower amount, and if it's wrong, then you record the higher one, then to record the higher one.
Right, because and why do you think would be one of the main driving points as far as that for why they would actually make that a rule?
So the investor wouldn't be like fooled almost.
Right. Because they don't want to portray it as something that it's not. Because obviously if a company looks as if they have a very strong earning capacity, then it's going to be very attractive to the outside investor, and they're going to want to dump money into that. And if they're really not that powerful, then the returns aren't going to be what they expect. And on the flip side of that coin, liabilities, higher amount is chosen. Why is that?
For the same reason.
Same reason, right? Same reason. You want to go with the higher amount of liabilities, and you want to go the lower of the 2 with assets. So it all comes down just to the theory of conservatism. I cannot talk today. My gosh. Results in an income statement with a low or conservative income figure. So that's what our focus is here. Okay, the objectives for the audit of revenue and expenses. Once again, we're going to go through this because we know it's kind of redundant how we go through it, but once again, repetition's the father of learning. So we want to use the understanding of the client and its environment to consider inherent risks, including fraud risks related to revenues and expenses. And we all know some of those fraud risks could be just, maybe they're using the complete opposite of what we just said. Maybe they're going with the higher of the 2 on the asset or income recognition and going with the lower on the liability. And maybe that's one of the things they're doing. Maybe, they're just accounting for revenues that really shouldn't be a revenue. Maybe it's really should be a liability on a consignment to, the people who actually truly own the inventory as opposed to, revenue. So it's just stuff of that nature. Consider the internal control over revenues and expenses. We want to assess the risk of material misstatement of revenues and expenses and design further audit procedures. And these audit procedures are going to establish the occurrence of recorded revenue and expense transactions, the completeness, the accuracy, the cutoff, and the presentation and disclosure. So I'm not going to just read verbatim through that because we all know it's the same theory, the same objectives that the auditor has. It's just pertaining to whatever element that they're auditing. So everyone good on that? Okay, some relationships between balance sheet and income statement accounts. This is an important figure right here. So if y'all want to make a little note on this, it's always good to understand the relationships between these accounts on how they move from the income statement and balance sheet. As you can see here on the far left column, the balance sheet item, accounts receivable. That's going to be sales on the revenue. That's going to be on your income statement. Obviously, you can see the balance sheet item here, and the revenue expense is going to be on your P&L or your income statement. So accounts receivable thing that's going to be tied to that on the income statement is sales, which would be revenue, and the expense would be the uncollectible accounts, because we all know that accounts receivable is carried at what on the balance sheet? Net realizable value, which is taking into account the allowance for doubtful accounts, the contra account. Okay. Notes receivable. The revenue is going to be interest, and the expenses will be the uncollectible notes, which makes sense there. Everyone understand that one? Okay, securities and investments. On your P&L, the revenue is going to be interest, dividends, gains, and investees income. Does everybody understand why it's saying investees income there under securities and investments as far as revenue on an income statement?
Because a trustee.
We all know what interest is off securities or investments. We earning interest. That's interest income. Dividends. We all know dividends. If we have an investment in the stock of a company, if the company is invested in the stock of other companies, they're going to receive dividends. We all know securities and investments can have gains and losses. But what's that investee's income? Why would that be a particular interest? Think of
maybe because part of the investor's income, the percentage goes to the investee.
Because they might have because they might have to account for it under the equity method. Remember, if they have a certain amount of ownership of a company, you either control it with 51%, or you can have significant influence. So that's where that ties into from your intermediate. That's what they're talking about there. Did you all cover that in intermediate as far as you had to use the equity method to account for investments? And then you have to actually remember how that broke down, and then you get a percentage of their earnings because you have significant influence. So that's what the investee's income is tied to with that securities and investment. Everyone, does that make sense to everybody? Okay, and obviously the expenses is going to be losses attributable to those elements or those items. Inventories. There's not going to be any revenue on that. You're going to have on the expense side is going to be the purchases, cost of goods sold, and payroll for the inventories. Property, plant, and equipment on the balance sheet. The revenue side of that on your income statement is going to be rents and gains. Why would gains be stuck there under property, plant, and equipment?
If you sell it.
Right. And then obviously your expenses is going to be on your depreciation and repairs. A little more on property, plant, and equipment. When do you know the difference between whether something should be expensed as a repair or if it should be capitalized and added to the actual base or to the cost of the asset?
If it increases the useful life, it should be capitalized.
Yep, bigger, better, more efficient. So just that's keep in mind too, because that's important to know if you're going in to see in regards to their property, plant, and equipment. if they've been expensing it correctly or if they've been capitalizing it correctly. Because a lot of times firms will want to actually maybe try to capitalize something to where it won't hit their P&L and it'll just increase an asset, but in all reality, it didn't meet that criteria where it should have been expensed. So just another way firms can go about overstating their income or their assets, either way. Intangible assets, we all know intangibles, what they are, right? Royalties will be your revenue, and your amortization is going to be what ties in as the expense on the royalties. Prepaid expenses, nothing on the revenue side. Expenses, it'll be the various expenses. We all know the prepaid expenses, what those are. Accrued liabilities, nothing on the revenue side. Expenses, it'd be various expenses. We went over the liabilities, short-term liabilities, the accrued liabilities in a prior chapter. Hopefully everyone's familiar with those. Interest-bearing debt on the balance sheet. The expenses of that's going to be interest, obviously. So this is a very important chart here. So y'all just make a little note on here to just keep up with the relationship between the balance sheet and income statement accounts. Okay, miscellaneous revenue. Mixture of minor items, some non-recurring and others received at regular intervals. The auditor should analyze account to look for items improperly recorded as miscellaneous. Collections on previously written off accounts or notes receivable. Write-offs of old outstanding checks or unclaimed wages. Proceeds from sales of scrap. Rebate or refunds of insurance premiums, and proceeds from sales of plant assets. So these are all items that could be considered miscellaneous right here, because they're not miscellaneous would mean that it's not what? It's not tied to a corporation's what? Normal
operations.
Right. Normal operations and producing their normal producing revenue operations. So that's another kind of way to think of it. If because it could be industry specific. We know if a hospital, their normal revenue producing is going to be seeing patients and treating patients. The more patients in, the more money they get. So obviously, geared toward whatever industry you're in. If you can pick out what their sole revenue producing operations are, by default, you can pick out what should be in their miscellaneous revenue category. That's just another way about going that. And some things that the auditor should do: propose adjusting journal entry to classify items correctly if they're not classified correctly, because we want to make sure that the users of the statements are seeing where the revenue is being produced. So if it belongs in one of the main revenue producing elements of the statements, they want to make sure it's properly classified there. Perform analytical procedures and investigate unusual fluctuations. Detect material amounts of unrecorded revenue and significant misclassifications affecting revenue. So that's right there with the analytical procedures. You'd want to tie it from different periods and just take a look to see if you're going to have a spike or a change in those miscellaneous accounts there. And if so, you want to investigate and vouch as to what's taking place in those accounts. Okay, substantive tests for selling, general and administrative expenses. We want to perform analytical procedures, develop an expectation of the account balance, use budgeted amounts, prior year audited balances, industry averages, and relationships among financial data and relevant non-financial data. Determine the amount of difference from the expectation that can be accepted without investigation. The used estimates of materiality. So on that right there, if the auditor thinks that something's going to be material and have an impact on the financial statements there, then they're going to want to look into it more. If it falls, underneath the materiality threshold there, then maybe not so much as important if it's not going to have an overall effect on income on those financial statements. compare the company's account balance with the expected account balance, and investigate significant deviations from the expected account balance. They want to obtain or prepare analysis of selected expense accounts. We can examine accounts based on the results of analytical procedures. So once we go through those analytical procedures, whatever those results are, use those as our benchmark against what the management's estimates have. And which accounts to spot check. The AICPA suggests that we spot check the advertising, research and development, legal expenses and other professional fees, maintenance and repairs, and rents and royalties. That's probably going to be your main accounts there. Obviously, if they've geared the auditor to check those accounts, that's going to be most likely place for the misstatement to be. Obtain or prepare analysis of critical expenses in the income tax return. All right, this right here, the professional fees analysis, figure 16.1. I'm not going to really go into this right here in class, but if you just take a little bit of, take a moment on your free time to read through these, and you'll get a general idea. And once again, you can just see there's the date, the reference, and the pay, the description, and the amount. But just read through that on your own time, and that'll give you a little insight on the actual the analysis there that the auditor will do. And you can see at the bottom of that the little tick marks and everything at the bottom for what they relate to on the actual analysis there. So take some time when you're going over your readings to actually look at that and see the breakdown of that analysis figure. Okay, payroll. It's of great importance because it's usually one of the largest operating costs. It makes sense because obviously without the employees, the firm can't function. So payroll is going to be a huge expense. Payroll fraud had been common and often substantial, but now obviously with all the electronic software that they use for payroll, it's really mitigated the room for a lot of error like that on the personal level. Also, they have all the tax returns, the 941 payroll tax returns, the 940 tax returns, the state unemployments. So all these tax returns that we have to file with different authorities. So those can all be used to spot check as well to make sure there's no fraud and overstating expenses or understating the expenses. And extensive segregation of duties relating to payroll. That's very important. The auditor should want to make sure that the people preparing the time cards are not the same people that's actually inserting the data in and running the actual checks, making sure that the people that are cutting the checks aren't the ones signing them, making sure that someone that has nothing to do with the payroll department whatsoever is the ones reconciling the payroll account to make sure everything lines up. So segregation of duties is very important there. And once again, I already mentioned the use of computers with proper controls for preparation of payrolls, and also the filing of payroll reports with the government. So once again, those are your 941s and your 940s and your SUDAs and stuff of that nature, which makes sense because the 941s have to be filed every quarter, and it just recaps what your Social Security and your federal withholding and your Medicare, yep, and your employer's match. So that's an easy way to see exactly what it should be. The 940 is an annual return, but you have to make deposits, if you're over the $500 threshold. So all those are easy things in checking, just as when we were auditing like accruals for property taxes for other accrued liabilities. There's an actual source document there from the authority that we can actually check. So segregations of functions for payroll. Separate departments should handle the employment, the personnel, timekeeping, payroll preparation, record keeping, and distribution of paid employees. So we just went over there. I got a little bit ahead of myself on the other slide. Internal control over payroll. Some typical questions that the auditor could ask the client. Are employees paid by check or direct deposit? Why would that be a question that an auditor would ask?
Sure. I mean, direct deposit usually leaves a paper trail for the deposit.
Because if the checks are actually going to be like printed out and signed as opposed to clicking a button and it going straight in, then there's usually going to be more chance of something happening if it's going to actually have to go through the process, because then the checks are sitting out, then they have to be signed and they have to usually be remitted to the actual employee. So as opposed to just in the software, click the deposit and it's done. So that's a good question. So it's kind of just down to like, the internal control stronger if they have the direct deposit, because it's directly tied to the financial institution, whereas there's the checks being printed. Does that make sense?
Why would the company use a check system?
Well, I mean, just old school. We actually, the company I work for, we do not use direct deposit for any of the companies that they have. And why? I don't know. I wish we used direct deposit. I think most of the employees, it's way more efficient. It saves you on buying checks. It saves you on ink cartridges. It saves you, I mean, a lot of stuff. I mean,
You can't get lost.
right. It saves someone from having to sign every check, So I'm with you. I really don't know why companies still actually use checks unless they're just, it's hard to break old habits, if that's what people are used to doing a lot of times. One thing I could see, one argument for doing that, if it's like a size company that I work for, a lot of times our owner will come in on payroll days and he'll actually want to personally sign the checks. So that would be one of the reasons he could come in and actually look at them, before the checks are actually distributed and have the final look at it. So maybe give them a way of being more involved in the company, maybe seeing it more hands-on. But I think direct deposit's the way to go. But
in Europe, there are no checks at all.
Do what?
Checks in Europe are completely eliminated.
Oh, there is none?
There is none, zero. You can't find the checks.
So it's just all electronic based and cards, just cards and.
I mean, cash is still
right.
like this, but there are no checks.
That's interesting. Yeah, so we're way behind in the game. Is a payroll bank account maintained on an interest basis? Are the activities of timekeeping, payroll compilation, payroll check signing, and paycheck distribution performed by separate departments of employees? Once again, the segregation of duties. Are employee time reports approved by supervisors? Why would that be important there?
So the person who writes a check doesn't just randomly write a check to himself.
Oh, I get 80 hours overtime this week. Yeah, that's right. Is the payroll bank account reconciled monthly by an employee having no other payroll duties? Obviously, you're not going to want the person that writes the payroll checks reconciling it, because if they shot a check out there that shouldn't have been shot out there, then they can, they're reconciling it. They're going to see it. What's an industry that, I don't know if y'all know this, but what's an industry where employees are actually required to take one full week off? Like without, you can't take a day here, a day here, a day there. You have to take 1 week off. Banking.
Oh, the Sundays?
No, employees have to take an entire week off from work. And here's the reason why. It's because it all comes down to segregation of duties. A lot of times there's been fraud at banks, because if that person takes a week's vacation, chances are if they're doing something that they should not be doing, it's going to be uncovered within that week, because a lot of times they could divert funds into different accounts, and obviously it's breaking the law, but it happens. So and within banking industries, it's standard. You have to take at least 1 week's vacation. So that's just a real life example of how certain industries will actually tailor that into their actual requirements within the contract. And you have to do it because then, if Sally comes in here and takes over Patty's job for a week, and Patty's been reverting funds to her account or somewhere else, chances are within that week that she's going to catch that because she's not there to cover up her own her footsteps. So that's just a little example there. Um, uh, are all operations involved in preparation of payrolls subject to independent verification before the paychecks are distributed? Um, Test of controls for payroll. Perform test of controls over payroll transactions for selected pay periods, including the following specific procedures. Compare names and wages or salary rates to records maintained by the Human Resources Department. What's what? Why would that be? Why would you want to compare that with the Human Resource Department with the wages? With the wages paid from the payroll department, why would you spot check that to the HR department?
HR, when you hire a person, HR is the one who sets the rates and
right. They know that they have the employment package in there.
The contract itself.
Right. They have the contract which has all of the specs as far as the pay rate and all that, so they can spot check it to that. Compare time shown on payroll to time cards and time reports approved by supervisors. That's straightforward. If payroll is based on piecework rates rather than hourly rates, reconcile earnings with production records. That makes sense, right?
What's a piecework rate?
So, like, if I'm paying you based upon how much you perform on a job as opposed to the actual hourly rate. So I'm not paying you by the hour. I'm paying you, okay, hey, I'm paying you to put 10 units on this, so I'm paying you by your progress. Kind of the same thing as long-term accounting for construction contracts. Same thing. We're paying based on the billings. You do some work, you bill, and do some work, bill. So it's based upon that. So you're gonna check it with the production, what's being produced, what the productivity's been as far as what they've been paid. Okay, it's like so guy shouldn't be paid for the full job if he's only done a third of it. He should be paid for a third of it, so that should match in. That's all that's saying there. It's based on productivity or production. Determine basis of deductions from payroll and compare with records of deductions authorized by employees. Test extensions and footings of payroll. Compare total of payroll with total of payroll checks issued. Compare total of payroll with total of labor cost summary prepared by cost accounting department. If wages are paid in cash, compare receipts obtained from employees with payroll records. If wages are paid by check, compare paid checks with payroll and compare endorsements to signatures on withholding tax exemption certificates. And if wages are paid by direct deposit, compare listing of employee payments with payroll and direct deposit authorizations. And observe the use of time clocks by employees reporting for work and investigate time cards not used. So pretty much, you just want to spot check the sources from where the time's coming from, who signed the checks, and just so on and so forth. Everyone good on that? Okay, some data analytics tests of payroll. Identify duplicate payroll checks, whether it be direct deposit or cash payments to employees within a pay period. So if someone's receiving 2 checks, why are they? It could be legit, maybe like, for example, in our company, usually on the first bi-weekly payroll of the month, our salesmen will usually have 2 checks on that payroll. One will be their commission check because they're on a draw pay commission. So it's not out of the norm for those salesmen to actually get 2 checks in that pay period. But you always want to the auditor wants to spot check that if there is some employees receiving more than 1 check in a pay period. Identify multiple payments to the same bank account within pay periods, both with the same and different employee names. Identify pay deposited to the same bank account of that of a vendor in the vendor master file. So why would that be important? just making sure that the master file and that file matches up. Really, it really wasn't much to. I just wanted to just spot check you, make sure people pay attention a little bit. That's it. Identify false, invalid, or duplicate Social Security numbers. Identify differences in pay between union agreements and actual payments, and compare and summarize costs for special pay, overtime, and premiums. Okay, and then this figure 16.2, the substantive procedures for payroll. Go ahead and mark this chart here. This is very important here because these, once again, could be great exam questions here. It's very, very important to know what the audit objective is when you're performing a substantive procedure. Okay, and for example, perform analytical procedures for payroll. The audit objective of that is going to be for existence and occurrence. If we're going to investigate fluctuations in salaries, wages, and commissions, that's going to be for completeness. Obtain a summary of amounts of officer compensation and traced authorization. So all of those are going to be for existence and occurrence, completeness, and accuracy.
All of these are in this.
All those ones that I read right here within that top section right there are for existence, occurrence, completeness, and accuracy is what you're checking for with those substantive procedures.
All five is what you check for.
So out of the substantive procedures up here.
So perform analytical procedures. It includes all five existing occurrence,
completeness, and accuracy. If on this here for the audit objective, that's when you're performing the analytical procedures. What the objective of performing those is to verify the existence, occurrence, completeness, and accuracy. And what these audit objectives are, and obviously it ties back to that redundant thing that we start every lecture with. Obtain an understanding of the environment, inherent risk, and then the substantive procedures that verify completeness, existence. So this is those substantive procedures, and it's tying into what those objectives are. That's why I want you all to really know what the objectives are. Because if you know what your objectives are, obviously, then if you know what you're trying to achieve, what your objectives are, then you know what substantive procedures should go along with it, what the auditor should perform.
What's the difference between existence and occurrence?
Between what?
Between existence and occurrence.
Between existence. What is the difference between existence and occurrence? Well, if it existed and occurrence, it's pretty much the same thing. I mean, if it exists, like if it exists in the financial statements, pretty much, you want to make sure that it actually occurred. So, I mean, the existence and occurrence, that's why usually you'll see existence and occurrence, they're parallel to each other. So if it exists in the statements, then it had to have actually occurred, right? So that's why you're always going to hear existence and occurrence. So it's one and the same thing, but to have one, you got to have the other. For something to exist, it has to first occur, right? So that's why you always see existence and occurrence. Sorry, I didn't really understand your question first. Does that make sense, though? I mean, okay. Another substantive procedure is to test the period end accrual of payroll expenses, and the primary audit objective of that will be existence and occurrence, completeness, accuracy, and cutoff. And does that make sense as far as what the objectives are? That's a pretty easy one here. Test the period end accrual of payroll expenses. So why would that test for the objective, the auditor, why would that have anything to do with cutoff?
So you don't delegate the expenses incurred in the year to a different year,
right?
So you can include the income.
Right. Why would that be substantial to existence and occurrence? Why would that be an objective of testing the period end for accrual of payroll expenses?
I mean, because
the employees actually work, they perform, we owe them. It's accrued payroll expense. So we want to make sure, okay, they actually did it, they actually worked. So that existed and it occurred. So that means that's why that's an objective of that as well. The completeness, because we want to make sure, okay, make sure all those hours that are there, make sure they're completely accounted for in that period. Accuracy, obviously, that's the same thing. We want to make sure it's accurately accounted for in the period. Like you said, we don't want wages earned in December being affected as an expense in January. So does that make sense why your objectives are like for the payroll accrual?
Yeah, but why would you do that? It's increase your income liability.
Do what?
Like tax liability if you underestimate the expenses.
You said, sorry.
If you don't record the expenses, that would increase your tax liability because you underestimate the expenses, it increases the income, therefore the tax liability. So it doesn't really make sense.
Right. No, but I mean, but that's why that the auditors is checking that. That's the whole point. The objective of the auditor in doing that is to make sure that none of those expenses, like you said, are understated, or which in turn, like you said, would increase the tax liability because it's going to obviously in turn less expenses to more net income. But that's the main point there is just make sure you understand what the substantive procedures objectives are for the auditor when they use those substantive procedures. So, the other one at the bottom, test computations of compensation under profit sharing or bonus plans, test commissions earnings, and test pension obligations. That's all for accuracy.
Why wouldn't that have, like, for example, completeness? That's an obligation.
I really don't know, honestly. That's what the author of the book decided to go with. Honestly, I really don't know, and that's with that question right there. Honestly, and that's I think can be the confusing part of learning these is because it almost feels like on some, well, why didn't they use that for other ones? Why did they use that for this one? But if you stop and think about it, for the most part, it makes sense. But really, if you have a general idea with these, I don't expect you to memorize these charts. So then when I say that, don't like memorize them, just have a good sound understanding of what those substantive procedures are for, of what the objective of the auditor is trying to get trying to accomplish with those substantive procedures. So that makes sense. Okay, the audit of statement of cash flows. Amounts are audited in conjunction with the audit of balance sheet and income statement accounts. Why is the statement of cash flows audited in conjunction with the balance sheet and income statement?
So I mean, cash appears on the balance sheet. How much cash do you have on the revenue and expense on the income statement?
How do you build an income? How do you build a statement of cash flows? What two statements do you need?
How do you build a statement of cash flows?
How do you go about building it? What statements do you need?
I mean, you need obviously the depreciation and income statement.
And what else?
And the balance.
Right. That's why, because that's what's used to build the statement of cash flows is the income statement. What's the structure of the statement of cash flows for the for-profit businesses?
You go first operating, then investing, and financing.
Right. And there is two methods.
Direct and indirect.
Right. Yeah. And there can also be a section for foreign currency translations as well on the fourth component, but it's not usually mentioned a lot. If y'all study for the CPA, y'all dig into that. But for this purposes, it's just operating, investing, and financing. But there is a fourth component, but just ignore that right now. But that's what it is. So if you ever see that, it's for foreign currency translations can actually play a part in that. But just ignore that there. So that's why you want the auditor is concerned with the balance sheet and income statement when auditing the statement of cash flows, because the amounts shown on that statement of cash flows is pulled directly off those two statements. You can't build a statement of cash flows without your balance sheet and income statement. Now, with that being said, if a company does not present a statement of cash flows for within their financial statements, if it's not part of the financial statements, could they still get an opinion, a clean opinion on an audit report? You don't think they could?
Why would they?
I mean, do you think they could?
don't think they couldn't because that would mean they're hiding.
Well, think about it though. But you could build one with if if they give you the balance sheet, unless it's changed. I'll look into it. But my last audit class, I was taught that actually they could still get a clean report because they can actually you can build the statement of cash flows with the balance sheet and the income statement. So you have those two. I'll double check into that to make sure I'm telling you all correctly, but that was just a trick question that was thrown towards us, was if they could get an unqualified opinion with the omitting statement of cash flows. But I will double check to make sure I'm telling you correct. I believe I am, but it makes sense though because you have all the material you'll need.
So why should the auditor do the statement of cash flows?
Uh,
Why would the auditor do a statement of cash flows for the company? Company's supposed to do.
Right. No, I mean they might go to them and make them do it, but I'm pretty sure theoretically that they could still issue an unqualified opinion without one, and they could still issue it without a statement of cash flows, just because they've already got all the information they're needed for the statement of cash flows, even though it's not built. And obviously, right here, the presentation and disclosure objective is important because pertaining to the operating investing financing. So we all know the OIF for the statement of cash flows. And I will double check in to make sure that I'm telling y'all correctly on that. Audit procedures completed near the end of field work. We're going to want to search for unrecorded liabilities. Review the minutes of meetings. And what were the minutes of meetings? What is
board meetings?
Right, with the shareholders and the board of directors and everything. Perform final analytical procedures. Perform procedures to identify loss contingencies. And what are loss contingencies? When do they have to be?
Loss contingencies.
They should be disclosed. Remember, they should be accounted for and disclosed if they are what? I'll give you a little hint. Remember, the loss has been substantiated for a year, and it can be estimated. All right, we'll jump back up there. Yeah, so just keep that in mind. Just because obviously, if the auditor is questioning those loss contingencies, what's a good way that they could actually go about finding out about a loss contingency to make sure that they're actually disclosed? How could they go about that?
Usually, probably loss like contingent liabilities is related. It's related to contingent liabilities.
Yeah, that right. Contingent liabilities, loss contingencies. That's what they're talking about. Because remember, you never account for gain contingencies. You don't ever account for those. Only loss contingencies. So that's what they're pertaining to. But how could an auditor go about? And I'm kind of getting ahead on the slides, but just how could an auditor go about seeking that information if there's no loss contingencies being disclosed or accrued in the statements? How could they go about getting that information out of the client?
Usually, when they get a contingent liability, there's probably I think some kind of requirement companies.
Litigation. So you could actually seek their general counsel, their in-house attorney, and ask him questions as opposed to, and is there any pending litigation against the company? And ask them, what's your likelihood that this is going to go to court? What's the likelihood? Can you estimate what the outcome is going to be? So if there's nothing that's been accrued there or disclosed in the notes, the general counsel is a great place for the auditor to go to, which makes sense because the general counsel is going to be their in-house counsel, their attorney that the company uses that, is hired strictly for that company usually. And, he's going to have the insight on all of the, this stuff, the contingencies or lawsuits or any pending litigation that could be facing the company. So that's one of the main sources for the auditor to check, which makes sense, because if he has the information and it's not been disclosed, then we can come back to the client and say, hey, why isn't this in here? So just general counsel is a great place for the auditor to go to aim his questions. Perform the review of subsequent events. What's a subsequent event?
Like after the balance sheet date?
But before the auditor's report.
Yeah.
Right, that period of time before the auditor's report, after the balance sheet date, before the auditor's report. And we'll get a little more into that too. I'm saying obtain the representation letter. That's going to be from the actual client itself, from the executives of the company. Communicate misstatements to management and evaluate audit findings. More on loss contingencies. Loss contingencies should be reflected in the financial statement amounts when it is probable that a loss had been sustained before the balance sheet date, and if that loss can be reasonably estimated. So that right there is very important. Loss contingencies should be disclosed in the notes to the financial statements when it is at least reasonably possible that a loss has been substantiated. So remember, it's accrued if it's probable the loss has been substantiated before the end of the balance sheet date, and if it can be reasonably estimated, and if not, then it should be, if it's reasonably possible, it's going to be need to be disclosed in the notes. And loss contingencies need not be disclosed when the possibility of loss is remote. So remember, if it's remote, no need for it, because the chances of it happening is not that likely. Litigation, most common loss contingency, pending or threatening litigation. Once again, that's what we were just talking about. Letter of inquiry to the client's legal counsel. Provides evidence about pending or threatening litigation. Unasserted claims need to be disclosed if probable and reasonably possible. And the auditors should obtain from management a list describing and evaluating threatening or pending litigation for review by legal counsel. So does that make sense to everybody, why you would go to your general in-house legal counsel for such matters as that? Okay, other contingencies. Income tax disputes. Same thing there, because we could have paid less of an income tax to the IRS, and we could be under audit, and we know that could be a contingency because we could possibly owe more tax from the period before than what we actually paid, so we'd have to fork out more money. So that's another contingency. Accommodation, endorsements, and other guarantees of indebtedness. Accounts receivable sold or assigned with recourse. Do we all know what assigning, factoring, that gets into factoring of accounts receivable? Did you all cover that in your intermediate courses?
Recourse is when you sell your accounts receivable, and if that accounts receivable are not collected by the buyer, you still pay them?
You're liable. You have to set up an actual recourse liability account. All right, you're right. That's what it is. It's the recourse. Because remember, you factor them with or without recourse. Usually, in practical reality, it's always going to be with recourse usually. But yeah, that I was just making sure you knew.
Why would you do it? There's so much liability with recourse.
Oh, I know, right? It is, but it's just how it is. But that's what they're talking about there with accounts receivable sold or assigned with recourse. They want to make sure that if that is under the contractual terms, that they actually have that recourse liabilities account set up, and they're not just, then it's just totally factored as being sold without recourse. So that's what their main issue there is. Environmental issues, we all know that those could be huge as far as contingent liabilities. We all know, look at BP, for example, when that oil spill in the Gulf happened, so many years ago. So they still probably have contingent liabilities on their financial statements if we would actually go in and look at their actual 10K and read through all of their financials. So environmental factors is huge. Commitments and general risk contingencies. What's the largest contingency? Just do our the most common largest contingency is what? Pending litigation. Yeah, just backtracking a little bit. Okay, audit procedures for loss contingencies. We want to review the minutes of directors' meetings to the date of completion of field work. Send letter of inquiry to the client's legal counsel. Send confirmation letters to financial institutions to request information on contingent liabilities of the company. Review correspondence with financial institutions for evidence of accommodation endorsements, guarantees of indebtedness, or sales of assignments or of accounts receivable. Does all that make sense on that? Review reports and correspondence from regulatory agencies to identify potential assessments or fines. And obtain a representation letter from the client indicating that all liabilities known to officers are recorded or disclosed. So that representation letter is going to come directly from the executives of the company. Everyone good on the audit procedures on those? They're pretty straightforward there. Okay, this figure 16.3 is also very important. I would make a little note next to that. It's pertaining to the responsibility for subsequent events. And it's going to actually break down the interim period and the subsequent period for the two parts. Type 1 is your interim period for subsequent events, and type 2 is your subsequent period. Type 1 is going to be conditions that existed on or before the balance sheet date, and those are actually going to have to be adjusted in the actual financial statements. Whereas the type 2 conditions that arise after the balance sheet date, they need to be considered for disclosure, which makes sense because if it didn't happen before the balance sheet date, then it doesn't need to be adjusted in the statements because it fell outside that parameter, but it should still be brought to their actual attention and disclosed in the notes. So that's actually makes sense there. And if you can see here, it has a little timeline as well tied into that with the beginning of the current year audit work. And then there's the balance sheet date. Now for the subsequent period there, you'll see that the auditor will perform audit procedures to search for subsequent events between the balance sheet date and the date of the audit report right there. Now, between the date of the audit report and the report release date, which do you all know what the report release date is?
Report release date? I mean, when they officially release their opinion.
All right, when they actually, the actual audit report has the actual opinion on it, but the report release date is when they actually give the company permission to file it with their financial statements. That's what the report release date is. They've actually turned the authority over to the company and said, okay, here's your report. Now it's free to use for your, for the company with your financial statements.
It's available for the public.
Right, that's when they can go ahead and generate their financial statements, and because we all know the auditor's report is one of their components, which makes up a company's actual financial statements. So we all know publicly traded companies have to be independently audited. So, but from the time period between the date of the audit report and the report release date, the auditor is only responsible for information coming to the auditor's attention. So if nothing's been brought to our attention as auditors and we've already given our report, then we're only responsible for it if it's been brought to our attention. If something like there's a major contingency that we didn't know about and it's not brought to our attention, we're not responsible for it. But if we are, if it is brought to our attention, then we're responsible. So that means that it's going to require some action upon the auditor. Some audit procedures to identify subsequent events. Review latest available financial reports and statements and minutes of the board and selected committees. Inquiry about matters dealt with at meetings for which minutes are not available. Inquiry of management. Obtain the lawyer's letter, which once again we know that is dealing with the pending litigation. And obtain representations from management. Okay, the representation letter. The purpose of the representation letter is to have the client's principal officers acknowledge that they are primarily responsible for the fairness of the financial statements. It's dated as the date of the audit report, and it's not a substitute for application of necessary audit procedures. So that representation letter is very important, and I'm sure.
Why is it dated as of the date of the audit report?
Why is it dated as the date of the audit report?
Yeah, well, like.
Because when they're signing off, when they're looking at that audit report, when they're reviewing the audit report with the auditor, the upper management, then they have to sign it. It's dated that date because they're attesting to that at that point in time. So that's why it needs to match. That's why it's got to be dated at that point in time. Does that make sense? Because if they're gonna, like, I mean, think about it this way: if I come to you and say, hey, I need you to sign off and attest this, and the date's 5 years ago or 5 years in the future, then you're not going to really want to sign off and put your name on that because you have no clue what it could be then. But if it's at the actual point in time, then it makes it, it makes it more pertinent to the facts at that time. So that's why the dates have to be what they are. So representation letter. Misstatements. Factual misstatements, specific misstatements identified during the course of the audit for which there is no doubt. So that's, the auditor sees there's a misstatement and there's no question to it, there's a misstatement. So that's a factual misstatement. Judgmental misstatements, differences like judgments like in estimates of depreciation or amortization or something of that nature. The auditor's judgments don't align with the management's judgments, so they speculate on what could be the variance on that. Projected misstatements arise from sample results or projection of to population. So just the company's projections there. Okay, and then again, this figure 16.4, just the total likely misstatement overstatements here. I'm not gonna go through and piece by piece here, but I do suggest everyone taking a moment to kind of go through this chart here and make sure that you understand how the items are flowing through it. It's really not all that difficult. You'll see on the left here it has the type of misstatement and what account it's tied to, the type that it is, and then the assets, liabilities, and then the income statements, and then you just have the components there. So just take a little bit of time as you're reading through there because it'll tie in good with the content in the chapter to give you a little visual of the content there. Qualitative materiality factors. It's likely to be material when they arise from an item capable of precise measurement rather than that of an estimate. Mask a change in earnings or other trends. Hide a failure to meet analysts' consensus expectations for the company. Change a loss into income or vice versa. Concern a particularly important segment or other portion of the registrant's business. Affect compliance with regulatory requirements, loan covenants, or other contractual requirements. Increase management's compensation. Involve concealment of unlawful transaction, and are of an amount that management or the auditors would believe would affect this actual company stock price. Okay, evaluation of materiality, considering prior year uncorrected misstatements. Now this right here gives a little example. The situation is there's a $70,000 current year misstatement and a $60,000 balance sheet carryover from preceding year.
What does that mean, 60,000 carryover?
That means from the year before that it wasn't material enough so that it's still carried over. So you have to remember from the period before when they determine how sometimes it has to be, I think maybe, I don't know if you might have not been in the class, but we talked about the misstatements in aggregate. You might have been, or like it's all based on materiality. So if there's a misstatement in 1 year, let's say $2, and it doesn't affect income, the auditors let it slide and they still give them the unqualified opinion. They have to keep up with that effect. So if they see if there's a $4 misstatement on this year's, they still have to take into account the misstatement from last year because it carries over from period to period. So that's what it's talking about, the 60,000 from the balance sheet from the last year carrying forward on that. Does that make sense? Because you have to keep up with it in aggregate because maybe for one period that $2 isn't material to the financial statements, but if you compound it over a numerous amount of periods, eventually it could become a material amount. So you would have to actually account for it. Does that make sense? And there's actually two ways about going about it. 70,000 current year misstatement, 60,000 balance sheet carryover from a preceding year. If either the 70,000 or the 130 total, the 70,000 plus 60,000 is material to this year, an adjustment must be made. The current year's income is decreased by at least 70,000. If the 60,000 is immaterial this year, it will also decrease the current year. If the 60,000 is material this year, prior year financial statements should be adjusted. So does that make sense there? Now, as far as like because it's still the same client, still the same financial statements, and whether, it might not be material that year, but like I said, from year to year, it could become material because at the end of the day, it could build up to have an effect on the overall accuracy of the financial statements. So everyone, does that make sense to everybody? Okay, review the engagement. Review of work of audit staff accomplished the review of audit working papers, typically performed by seniors. So, at the end of the audit, obviously they're going to have their staff and their grunt people performing all the field work and going through and preparing all the audit working papers. And obviously it's going to be reviewed by the manager or by a partner that's overseeing the audit. Review of working papers not completed until near or after the completion of field work, which makes sense. Partner and manager devote attention to accounts with higher risk of material misstatement. And then even after the partner and a manager that is assigned on the audit actually reviews the working papers, and another partner actually comes in that's not actually on the actual engagement, that's not been assigned the engagement, will actually come in and review the prior to the issuance of the actual audit report, which makes sense as well. You just want to make sure that there's a little independence there, having someone outside a party come in and spot check the work there. Reporting on other information with the financial statements. Once again, this is an important figure here. Circumstances giving rise to other matter paragraph. Other information and documents containing audited financial statements. The effect on audit report if properly presented. No change required. Let's see here before I go in here and bore you with this. So just on instead of me just reading through here, just reading this straight off the chart here, just put a mark next to this because this is a very important figure here. Okay, required communication with those charged with governance, fraud and illegal acts. Obviously, we're going to want to bring that to those charged with governance. Now, it is important to know that if the auditor does find fraud or illegal acts, it's not his responsibility to report it to any agencies outside of the company, but it is their responsibility to report it to the board of directors or the audit committee, usually the audit committee. And whether they do that, that's on them. But the auditor has fulfilled his duties by reporting it to those charged with governance. Significant deficiencies and material weaknesses, obviously, those are going to want to be reported because if there's material weaknesses within the company, they need to be brought to the attention of those charged with governance so that they can be remedied. Auditor's responsibility under generally accepted auditing standards is to form and express an opinion and management's responsibilities. An overview of the planned scope and timing of the audit. Significant findings from the audit. Some of those significant findings would be qualitative aspects of accounting practices, audit difficulties encountered, uncorrected misstatements, disagreements with management consultations with other accountants, auditor independence issues, and other matters that the auditors feel are significant. And what is that auditor's independence issues? Why is that so important there? auditors have to be independent,
Yeah.
and they have to make sure that they're revolving off the engagement. I believe it's every 5 years that they have to change to a different engagement team. Post-audit responsibilities for the auditor. They need a subsequent discovery of facts existing at the date of report. They need to advise the client to make appropriate disclosure of the facts to anyone actually or likely to be relying upon the audit report and financial statements. If the client refuses to make the disclosure, then the CPA should inform each member of the board and notify regulatory agencies. So that actually is different right there. As far as the auditor's responsibility. Remember, as far as fraud or anything within the company, then the auditor's responsibility is not to report it outside the company. It's to the board of directors. But in this case here, on the post-audit, if facts of circumstances come to their attention, then they do report it to those charged with governance. If they don't do anything, then in that case, the CPA should, take it into his own his own hands and to do it. And it makes sense too, because why would they do that? To make sure it goes to the regulatory agencies.
Because it's not their responsibility.
Right, because they're auditing, their name is on that audit report, so therefore they have the responsibility, because they're liable for that audit report. So if people are, saying, okay, well that it's been audited, and there's the report, then it's got to be legit. So that's why in this case here that they would want to notify the regulatory agencies if the firm doesn't do the right thing there. Subsequent discovery of omitted audit procedures. Discovered during peer review or other subsequent review of working papers. Assess the importance of omitted procedures to their previously issued opinion. And once again, if there's some of those audit procedures that have been missing, then it could have an overall effect on what the auditor's opinion was on the financial statement. So that's why that's important there. And like it says here, if omission impairs ability to support issued opinion and report being relied on by third parties, then attempt to perform omitted procedure or appropriate alternative procedure. So you want to go about and try to remedy whatever the misstatement is or whatever the missed procedure is. That's actually it for that chapter. I know that wasn't the best delivery there. I apologize. It wasn't the best day, but does everyone understand this chapter pretty much? So I know it's with audit, like I said, once again, it's a different subject to study just in general, but I think as long as you understand the elements you're auditing and just the scope you have to operate in the framework, then you should be good. Any questions regarding anything from this chapter? Anything that seemed confusing, or everything's going okay with the Connect exercises?
Yeah. And I'll email you about the audit.
Right. Yeah. Please email me that. And once again, this is the last chapter that we're going to cover before the midterm in this class. So, like I said, my plan is for next Monday to have a good review on what y'all need to focus your efforts on for the exam, and also hopefully have the midterm project. And just to get a little insight from you all, do you all prefer working in groups or individually on projects? I mean, I'll take it into consideration. I haven't made my mind up whether I'm going to do. I'm kind of indifferent on it. I feel like it can be beneficial, and I feel like it can be really crappy as well, because a lot of times people don't pull their weight and other people pull more weight. So just if it's something to think on. So no, you don't need to tell me how you feel about it now, but just keep that in the back of your mind moving forward. That way, if I have the project picked out by Monday's class, maybe we can have a little discussion and see how people are feeling. Hopefully, people listen to this on the lecture as well, so they'll know about it as well. But I want to I value your all's input and stuff. And at the end of the day, you all are going to be the ones working on it. So I want to just see how what your all's thoughts on working either individually or in groups. So just think on that a little bit as well. But yeah, that's all I have for you. And like I said, we'll go over what'll be on the exam on the next class on Monday, and hopefully the project as well. So hope all y'all have a good day, and I will see everyone on Monday. And just feel free to email me if y'all are, stuck with anything and having trouble with anything. So, and definitely email me the thing for that quiz.
Thank you.
Oh, you're welcome. And once again,